Hi, my name is James Longstreet. I'm the president of Fivefold Wealth Management. And today I'm speaking with a special guest, Mark Taucar from Toronto, Ontario. Mark is the senior portfolio manager at Excellent Capital Management. He has over 23 years of experience in managing money. And Mark uses a sophisticated model, which he created himself, to manage money and protect wealth. And he focuses on protecting wealth through risk management and hedging strategies. So Mark, without me saying too much more, why don't you start by telling me a little bit more about yourself, about your career path, and how you ended up at Excellent Capital.
Thanks, James. Yeah, the career path started about 23 years ago. My first year in the business was 1998, just the latter part of 98, and became one of the youngest licensed registered representatives in Canada at the time. And from that period forward, I've essentially been a client front-facing investment person. In and around 2003, I attained the Chartered Financial Analyst designation and started work with angel investors as well. So not only individual investors who wanted to invest in the market, but had worked with a group called the Toronto Venture Group and had managed their subsidiary called the Toronto Angel Group. And we were doing the Dragon's Den before there was ever a Dragon's Den, So from there, I became a portfolio manager. So started off as a registered representative and then graduated into portfolio manager, having attained the Chartered Financial Analyst designation, and started work with a company called R.N. Croft Financial Group, where we manage upwards to about $375 million of client assets. And then from there, transitioned into a firm called Cumberland Private Wealth Management, whose principal there is Jerry Connor. Jerry had started Connor, Clark and Lunn as one of the partners there, and had moved on to create Cumberland Wealth. And at R.N. Croft Financial Group, I had worked to build referral platforms, and much of the same structure that you and I work with, where we have experts in your field as planners, insurance agents, private equity specialists, who would then require the services of professional money managers like myself and would refer their clients over to us. So that's kind of what I did over at Cumberland as well, help them build out their referring platform, and they managed upwards to about $2.2 billion. And just like many of us who start off in this business, the question always comes around, do we continue to do it for everyone else, or are we going to start building these platforms for ourselves? And so I had made the decision to build Excellent Select, which is a discretionary managed account service for a referred clientele, in partnership with Dan Pembleton, who is the president over at Excellent Capital Management. And so I kind of describe the evolution of this platform using the old Reese peanut butter cup commercial, where you have one guy walking down the road with chocolate, the next guy with peanut butter, we bump into each other, and voila, we've got a better candy bar. And in much the same way, my experience has always been on the public side of the markets, so managing your traditional portfolio, and Dan's expertise has tended to be on more of the private equity side. And so our goal for clients was to create a platform that had the best of both worlds. And so we looked at examples like CPP and Ontario Teachers Pension Plan and BCIMC and many endowment funds that you see. And what you'll find is that some of the best diversified portfolios have both a public and private component to it. And so that's what we do. We combine those into a program that individual investors who would otherwise not be able to gain access to these types of services now have the ability to come to us through individuals like yourself and be able to work together with us to build solutions for themselves.
Yeah, well, that's great, Mark. Thanks for sharing that, a little bit about your background. And it's very clear that your full-time passion, of course, is managing money. And I'm just curious, Mark, what do you like to do for fun? What are you passionate about outside of managing money?
Well, certainly anytime I can get away from work, I like to hang out with family. We have a family cottage we go to in the summer months, and then I don't know that I can really call myself an athlete of any sort, but I do like to participate in triathlon, and I'm scheduled this year to participate in a half Ironman. So whenever I get some time and I'm not on my computer, on calls, or managing portfolios, I'm either riding a bike or out running or in the pool swimming. So that's kind of what I like to do on the sideline.
Wow, a half Ironman. That's that's pretty impressive. I've done two triathlons, but they were very, very, very short ones.
Yeah, you can call into question my sanity sometimes. So certainly I do.
Yeah,
When I'm in those races, you kind of think to yourself, geez, I don't know why I'm doing this, but I do.
yeah, that's impressive. Wow. Well, love to hear how that goes. Uh, so, Mark, next, I'd like to move on and ask you a few more questions here. First, how would you define your investment management style for clients? And then secondly, I'd like you to talk about some of the differences between passively managed money, which I know you've been involved with in the past, and now you're more actively managing money. So what are some of the differences, as well as some of the pros and cons between passively managed and actively managed money?
Yeah, those are great questions. So, I would describe our style as being dictated by our clients. And when we started Excellent Select, we made a conscious decision to really target certain types of clients to work with. It was our firm belief that you can't be the solution for everyone, and that you have to really focus on individuals who have a specific need, and us really focus on trying to reach those objectives. So earlier on, what we wanted to do is really start to work with pre-retirees and retirees. And as you can appreciate this, James, because you and I have had many discussions with clients, many of these clients, when they sit across the table from me, they'll say, listen, Mark, James, we've worked for 30 to 40 years. This is our nest egg, whether it's $100,000 or $3 million. Please manage it as if it's your own money. Manage it as if it's a pension fund, and don't blow it up. And to a T, that's what clients really say. And so from our approach, what we've always wanted to do is to protect on the downside, be conservative in our approach when it comes to volatile markets, and to ensure that people aren't losing any sleep. And then when the markets are in a spot where we're starting to make gains and returns for clients, that clients can have some comfort that we're going to make steady and steady high frequency type of gains that they can rely on. And so our approach has always been one where we take diversification very seriously. We would call ourselves global managers, global asset allocators as well. We have a tactical approach to every portfolio that we manage. And so really it's about dealing with what the client is looking for, and what their risk capacity, their risk willingness, and their risk needs will allow for in a construction of a portfolio. And then it's matching the right portfolio to them, which includes 3 asset classes. We take a look at the world in 3 different types of buckets. We consider an income asset class, an equity asset class, and an alternative strategies asset class as to be separate and combined separately for clients. In the income asset class, we think of anything that has cash, fixed income, preferred shares, and high-paying dividend equity as an income type asset. And they tend to move differently than pure, what we would call growth equity. Most income equity or preferred shares, if you're looking at preferred shares, you get a dividend stream in an income equity situation where you have a high-paying blue chip stock. The vast majority of their bottom line is being paid out as a dividend. And when you get up to the equity situation, really what we're looking for is we're looking for companies that still make a good income. They're solid companies, but they're not necessarily concerned about paying out so much of their dividend as they are in terms of trying to grow their company. And then lastly, in our alternative strategies category, we would include things like commodities, gold, covered call writing, options, option strategies, and then also private equity. And what we'll do for clients, depending upon that time in the market, is we have an ability to swing in and out of any one of those asset classes and weight them more heavily. And so, long explanation, but that's kind of a general way that we look at building portfolios and managing them for clients. And to your next point, the passive and active approach. So, the industry has kind of defined passive investing as the use of exchange traded funds, almost a set it and forget it type of feel. You take a look at different asset classes, combine them together in these unitized offering called exchange traded funds, which trade on the stock exchange. And, you do an initial risk questionnaire, investor profile, and typically what would happen is a result spits out that says you're a balanced 60-40 or 50-50, and these are the combination of asset classes that you should have in exchange traded funds. And so most people, when they're interested in passive investment, it really is kind of a set it and forget it. We're going to buy a bond exchange traded fund, an equity exchange traded fund, and perhaps maybe there might be an alternative exchange traded fund. The advantage of that is that if you're looking for really low cost management, certainly exchange traded funds are the place to go. The disadvantage of that type of approach is that you don't have the expertise of someone who's watching the market constantly and swinging the portfolio to take advantage of ebbs and flows. So if you're in a set it and forget it approach, and let's say you're a growth investor and the majority of your assets are in exchange traded funds that are equities that mimic the benchmark, well, guess what? When the pandemic hit, you would have seen your portfolio fall by almost 40%. And so most people, they don't have the willingness to see that level of volatility in their portfolio. And so that's why when you're looking at something a little bit more active, you can actually use some of these passive securities. But if you're making active calls to swing components into more risky or more or less risky asset classes, you can actually mitigate a lot of the volatility of that portfolio and therefore make people more comfortable with what they're invested in. And you and I both know that if clients are comfortable with the portfolio that they're invested in, then they're going to remain invested. They're not going to miss those major days, and there's only 3 or 4 of them in a year. And if you miss one of them, you miss a major component of the upside. And so they're not going to miss those days because they're fearful of seeing losses in their portfolio. And so that's kind of the approach that we take in our active management. We also pick stock based upon what we call a quantitative factor model. And it's akin to, I use the analogy of being a general manager for a basketball team. So if you're selecting basketball players and you only had one variable to select, what would that be? Most people would probably say height. If you have a team that has an average height higher than any other team out there, then you've got an advantage. And then, then you can start adding on other factors like speed and accuracy of shot. And so stocks for me are very much the same way. There are certain factors that we would look at that if they attain a certain threshold would indicate that that stock is suitable for inclusion in a portfolio because historically those stocks tend to do better. And regardless whether I like a particular stock or not, if it falls out of those thresholds, violates those thresholds to the downside, they're just eliminated from the portfolio. So that's a little bit about how we would build a portfolio, how we would use asset classes, between passive and active, and then our approach when it comes to actually picking stock as well.
Sure. Yeah, thanks for sharing that, Mark, and going into all that detail. It's a lot of great insight that you just shared. So let's just wrap up our conversation here. We're now in March of 2022. And Mark, I'd just like to get your perspective on your economic outlook, on where we are in current financial cycles, and just anything that's concerning you and keeping you up at night regarding the markets, regarding the global economy. Share that with prospective clients.
Yeah, we recently, in March of 22, where we're 3 weeks into this war in Ukraine with Russia. And even before that had happened, Excellent Select, our portfolio managers, were concerned about the markets. And the concern was driven by the level of debt that had made its way into the markets to support the economies during the period of the pandemic and lockdowns. So a lot of debt has been created over the course of the past couple of years. In addition to that, just simple consumer debt here in Canada, we're very indebted. We've got a lot of mortgages and credit debt, and so our concern here was that with all of this money being printed and all that money being put back into the economy, that inflation was going to rear its ugly head. And lo and behold, we've got the highest inflation numbers now that we've seen since 40 years, since the 80s, the early 80s. And if you take a look and put yourself back into the early 80s, how did they deal with inflation that went that high? Well, what they did is they started to increase interest rates. So Paul Volcker, when he came in, he was the Federal Reserve chairman back in the late 70s, mid to late 70s into the 80s. He essentially came in and said, we've got to control inflation because we're going to get into a situation referred to as stagflation, which is very low growth, maybe even negative growth, and then higher and higher prices, which is not good for an economy. And he came to be the chairman and started to increase interest rates to the point where people can remember getting a mortgage and having double digits percentage on mortgage, right? So now we're in a situation today where we've got a war that's taking place in Europe. We've got inflation as high as we've seen it, and we've got interest rates that are so low that there's only one place for them to go now, and that's up. And the concern now is we've got an indebted consumer, and if interest rates were to start going up, what does that mean for people who have bought real estate at housing prices that we've never ever seen before? They're hot historical highs, and they've bought them on the margin. And what happens if real estate here in Canada were to come down even 20 or 25%? So there are concerns. We have a lot of concerns. Moving forward into the year, we expect that volatility is going to remain high in the markets. And that actually works well in with one of our strategies, which happens to be our alternative strategy, where we expect covered call writing to do very well. Because as volatility increase, premiums tend to increase. And if you're writing these covered calls on, let's say, banks or utilities, which tend to be defensive, and they also pay a fairly strong dividend as well, I think that'll do very well. With inflation, I think you should be invested in some gold as well to protect, as it's always been a very good inflation hedge. And then really, you need to be looking at your portfolio and asking the question, do I own stock and do I own investments that can protect me when inflation starts to really take off? And so that would be companies that have the ability to pass on a lot of those inflationary pressures onto their consumers, who really have to buy the services of the company. So, we're talking about companies like Enbridge. Who's going to stop heating their house, regardless the price? Mobile phones here in Canada, Bell Canada, Rogers, Canadians would just as soon chop off their hand, as opposed to stop using their cell phones, and no matter the price, sort of thing. So I think our focus is on protecting client assets when it comes to inflation and the erosion of purchasing power by using commodities, also protect client assets in times of volatility by using covered call writing, and then really buying well-positioned companies that, despite inflation being so high, have an ability to protect their bottom line and protect their revenues.
Yeah, well, Mark, I really, really appreciate you you sharing that and going into that detail as well. So, yeah, Mark, I appreciate your time today. I really, really value your time. I really enjoy working with you. Maybe we can do one of these calls again at some point in the future. Really enjoyed it. And so with that, yeah, we're getting close to the weekend here. So I wish you and your family a wonderful weekend, and enjoy the training for the half Ironman. And
Thank you. It's a nice day outside today. It's 17 degrees
wow.
in the middle of March, so I might go out and go for a bit of a run.
Yeah, you got us beat by about 10 degrees here in Calgary. So, well, that's fantastic, Mark. Thanks again for your time. Have a great rest of the day and weekend, and we'll be talking again soon. Thank you.
Thank you very much.